talk a little bit about the fund flow jitter, the MSCI scare as well, and the overall liquidity move for the NBFCs. Sridhar Sivaram is the investment director at Enam Holdings, now joining in on the show. Thank you so much for dropping by to our studios and being with us. To begin with, let's just talk about how we're stacked up vis-a-vis some of the other emerging markets at this current juncture. Given the fact that we're seeing that evidence of a slowdown in China, are we somewhat better placed when it comes to the macros?
So to start with, we've actually significantly underperformed the emerging markets. If you see year to date, emerging markets have had a flying start. I mean, they're almost up 11-12%. China's up almost 15-16%. So there's been a significant underperformance for India. And maybe for the right reasons. We had our own issues with NBFCs and HFCs issues there, plus uncertainty with elections coming up. But I think this underperformance will not last too long, and our view is that we will see the underperformance bridge. So India will either move up or emerging markets correct, whichever way. My guess is that India will move up. So
what gives you this conviction though?
Because there is nothing globally to suggest that there's any major scare right now. The US-China tantrum trade war is going on, and we keep getting news flows on that. But barring that, we are seeing sort of a benign liquidity situation. Even the Fed has given sort of a benign outlook. So I would broadly say that given all this and the fact that India is significantly underperformed, and many of the stocks, barring say a group of 5 or 6 stocks, most of the others were beaten down much more than what is required. Not necessarily that earnings is catching up, but just that valuations of many of them start to look attractive. So our view is that we will see a catch up in the Indian market to at least closer to the emerging market.
Align with them.
But we outperformed in 2018, so some would argue that we are simply aligning with the reality. So the outperformance was so strong and so promising that the world was down, we were up, and now...
So the outperformance was a mirage. So take any average FI emerging market fund or an India dedicated fund.
You didn't say that in 2018, did you? Did you use the word mirage?
No, I'm just saying that it is just the 5-10 stocks that actually performed. The broader market and even the portfolios of fund managers. I mean, the average fund manager, I'm saying the FI fund manager, underperformed by 500 to 700 basis points in 2018. So it wasn't as if the portfolios did well. We had 5-6 stocks which held the market up, but we all know broadly that the market was in pain. It wasn't as if the market was giving a positive return. The portfolios were not showing that. And I think that is what is getting corrected now.
When you see instance like Z, Vedanta, a lot of promoter groups clearly getting exposed because of cross holdings, because of large debt at promoter holding or capital allocation. Does that worry a classic long-term investor like you? Are you worried about suddenly the corporate governance standard which some of the great and good companies are following?
100%, because you see, promoters, when they're doing well in one business, they tend to extrapolate and think that I'm doing well in this, I will be able to do well in something else which is doing well, and he has a missed out feeling that infra is doing well, or roads are doing well, or something else is doing well, telecom is doing well, I want to get in there. And how do I get in if I don't have? I pledge my shares or do whatever else to get the equity. But what we have seen now is that there is core competence for all promoters. They are good at doing something and may not be good at doing everything, and that results in minority shareholder interest being compromised. That's what we are seeing right now, and I'm happy that this has come to fore, because in many cases we didn't even know that they were pledged because the structure was so complicated that they need not have disclosed it as pledged because it is some structured finance and stuff like that. I think that has to be cleaned up, and minority shareholder interest has to be kept at the top. I'm happy that many of the promoters now have to sell their, as they call the crown jewel, to save their, indebtedness that they currently are sitting on, which I think is a good sign. It's a clean up in the market.
Right. Yeah. Sridhar, report after report this morning, or start of the week to now, the chorus is only getting louder for a broader market recovery. Now I know we shouldn't talk so soon, but somewhat, at least the ticker since last week is telling you there's something happening in the broader market. There is that revival and it's sailing through. But are you convinced about this move? Does it seem like the worst is behind us after a hiatus of almost a year and a half, or underperformance actually?
So I think the worst may not be behind us in pockets, and I can come to that later. But for the broader market, the valuations of many of these stocks have come down so much that I would want to believe that the broader market will rally. I mean, we've been meeting companies where consumer companies, not necessarily FMCG, trading at below 1x sales, paper-related companies trading at 2 or 3 times earnings. I mean, many of these were quite shocking. I mean, with adjusted, dividend yields were, unbelievable. So there was a disbelief in the market that, these will rally. Also, I think the entire PMS issues which came up. I mean, 2017 was such a great year for any investor that you need not be a fund manager at all. You will still think that I'm better than Warren Buffett because any stock that I bought went up. So you think investing is so easy. And then 2018 is a reality check. Many of these fund managers haven't seen cycles. So I'm not saying as if we have not made mistakes. Everybody makes mistakes, but it's just that understanding that there's a cycle. And that has resulted in this, I think the PMS have caused more damage to mid-caps and small-caps.
So you do believe that there is value within mid and small caps, yes, and that's beginning to be realized?
Correct.
Where did you think we went wrong? What did you assess which your assessment in hindsight is proving out to be wrong?
So I think last year we were bearish for a long period of time. We started getting comfortable sometime middle of last year.
Okay.
And then we had this ILFS issue, which was not in our sort of calculations, because prior to that, most companies were giving sort of bullish outlook that festive season may be very good this year, and you were starting to get that sort of a feel. Once ILFS happened, everything sort of collapsed because many of these NBFCs and HFCs are also funding consumption in many ways. And there was second derivative impact where projects stopped, real estate construction stopped. So I think all of that has had a significant impact on earnings, on the sentiments. I think some of that is now reducing. I won't say completely those issues are not completely over, but I think a lot of that is now looking like priced in. But as I've said in the past also, I'm still not believer that the problem for NBFC, HFC is completely over.
Okay.
And I think there are still issues which needs to be sorted out.
Are there going to be more skeletons coming out of the closet? I mean, as big as ILFS?
See, it's very difficult to say whether that will happen or not, but HFCs in particular have been very vocal on this, that their books are not the best, because if you take an average HFC, I mean about 40% is builder loan and a LAP combined. Mortgage is only about 60%, and the way HFCs are structured, they can restructure the loan and not disclose anything to the minority shareholders, because that's how the NHB regulations are. So it's not as if they are doing anything wrong. It's high time that we had an AQR for HFC, because you can't remember any large builder NPA for any HFC. And recently there was a presentation by one of the sort of a company which tracks real estate, that NBFC funding to real estate has gone up in the last 6 years from 35% to 65%, which means incrementally real estate has been funded predominantly by NBFCs in the last 4-5 years. And yet we have not seen any NPAs, whereas banks are declaring NPAs. So it's not possible, right? So I think there's a lot of things. We need what has happened to banks, which is now we are reasonably sure that for banks the NPAs that is declared is at least 90% right. In case of HFCs and the corporate facing NBFCs,
it's not even started.
Yeah, it's not even started. So I think that process has to happen.
Stories yet to unfold there.
Yeah, that is my broad view.
My only fear with that assumption, and it really is a genuine assumption, because that wheel is going to stop. That pipe is going to get caught. There's going to be a cog in terms of liquidity. If the housing sector does not do well, then there's problem for cement, then there's problem for steel, then there's problem for the economy.
Yeah.
I hope our assessment is not right, because
so what you're saying is right, but what will happen is my prediction is that many of these promoters will realize that their funding is stopped. because their main source of funding is either the banking system
or mutual funds.
Or the mutual funds. Mutual funds already stopped. Now it's only banking system where they have to beg, cry, and maybe do some selling of their assets to get some money. This cannot last for too long. So they will sell out of the business. And in my view, if the whole is say between 5 and 10%, because that's the broad feeling that many of these HFCs have a whole between 5 and 10%, then the system is safe because the shareholders' equity gets diluted. The system, which is the banking system, the bond market is safe because the new buyer, the equity holder has to take a haircut. The bond market is safe, which is broadly fine. I mean, if that happens, equity guys are anyway taking the risk. I mean, you should understand that there is risk here. So if you're taking risk, there is reward, but there's also pain. As long as the bond market and the banking system doesn't face the crisis, I think this crisis can be resolved. And one of the steps that NHB has now suggested, which is higher capital adequacy, is a step in the right direction. And if you keep increasing the capital adequacy, is only that much leverage that you can take. So I think these are steps in the right direction. I think they need to also ensure that restructured assets are disclosed to the minority shareholders. I think that's very important, because only then can investors assess between good, bad and ugly. So I'm not saying all HFCs are in the same basket, but the point is many HFCs may be hiding behind the easy regulations that NHB has.
Yeah, but 15% in a phased manner is what they're looking at. What about autos? More pain?
So autos, yeah, there could be pain, but it's a cyclical sector. So you make money when you buy at the bottom of the cycle. So I haven't seen, especially two-wheelers trading at 12-13 times PE for a very long time. Our view is that consumer discretionary will improve as we enter into election season and beyond, because once the NBFC issues get resolved, a lot of them are also funding many of the two-wheelers and discretionary spending in general. So I think in our view, this is a good sector to bet now, because it's a cyclical stock. You don't buy it at the top of the cycle. You buy when things are really bad. And given that India's penetration in many of these can still improve, there is a scope to play on this. I would look at autos. I mean, everything will not fall in place, right? Yes, two-wheelers. Yes, two-wheelers look very interesting.
Isn't the two-wheeler space a very competitive market? And when I say that, one side is demand and second side is competition. It's like telecom. Will I consume more data? Of course I will. Will I be watching more videos? Of course I would be watching.
Yeah.
But in case of two-wheelers, will the demand come back? Yes. But then you got Bajaj Auto, and they've sat cat amongst the pigeon by saying, we don't care about margins, we care about market share. What happens when the dynamics are changed?
I actually agree. I mean, that company should have done this a long time back. They lost 10% market share in 7-8 years. But I think they will reach a saturation point where they can't get more, because they do not have one entire segment, which is the scooters, which is also moving up. I think given all this is where the valuations are, and things will settle down. Even they have to make money at the end of the day for their minority shareholders. So I think there is a risk-reward play here. If everything was perfect, then you wouldn't get these stocks at these valuations, right? So you take a calculated risk-reward assessment of the sector, and you feel that if I look at the 10-year, 15-year history, these are valuations where it sort of troughs out. So your probability of making money in this is high. It could go wrong if they completely go the other way around. But that's the risk you take.
Now, what about Maruti? Is the worst in the price? I mean, we had the chairman quote just yesterday saying that he does see a pickup, but only after elections.
Yes, I will not comment on individual stocks, but if you ask me, I'm more comfortable with the two-wheelers than passenger vehicles.
So when you say two-wheelers, what about others like an Eicher? I mean, is Royal Enfield fad over? Would you say that Eicher does have a fair case to bounce back to those, that peak consumer company that it used to be 2 years back?
So that was the issue with autos, especially two-wheelers, that we were giving them consumer valuations and not discretionary valuations. So once you realize that these are actually cyclical stocks and you cannot give them consumer valuations, you would be fine. So as the valuations have corrected more to discretionary levels, your risk reward is better. When it is when a consumer discretionary gets priced at staples or consumers FMCG valuation, that's when you know you have trouble. So I think the risk, that's what I said, the risk reward is looking better for this pack in general.
Okay. One closing comment, and if I look at the dividend yield proposition, and classic investors have always taught me that any stock which gives you a dividend yield of 4.5 to 5% becomes a good attractive value buy.
Yes.
Well, guess what? There are not one, but like half a dozen stocks in the Nifty which give you this proposition.
Many more actually if you go down the curve.
NTPC. You can. I remember 5. You can tell me more names, but NTPC, Vedanta, Coal India, Nalco, HPCL, BPCL. Would you buy these stocks?
So I will not individually comment on this.
PSUs in general. Non-banking PSUs. Let me be specific.
So PSUs in generally I would avoid, but some of the banking PSUs to me are looking more interesting. Because our general thesis that's
not because of dividend yield. You like the business side.
Correct. I like the business side, but if I want to play dividend yield, I will also want to see if I have business certainty. And many of the private sector companies where I'm seeing good dividend yield also have good business prospects. So then I'm getting a combination of both. In this case, I'm only playing for dividend yield and I don't know what the government will do. So I would avoid PSUs for dividend yield. But there are many private sector companies which are trading at attractive dividend yields. In fact, we've been suggesting to them that instead of dividend, they should buy back, because in that way, they structurally reduce the total dividend outflow for the company over a longer period of time, plus the fact that it is more tax efficient.
It's the most inefficient way of rewarding minority shareholders, dividend.
Yeah, exactly. So I think that so many of the traditional companies have avoided.
That's 10 lakh plus, Sridhar. How many minority shareholders will be getting 10 lakh rupees of dividend?
No. So it is better for the shareholder also, right? Forget the 10 lakhs. Even as a normal shareholder, you are better off because
the EPS goes higher.
Yeah, because everything helps. No, once your shareholding comes down, you have to service that much lesser. Plus, the dividend outflow for the company for perpetuity is reduced.
Okay. Well, appreciate your time. Glad you could join us. We've covered a range of topics. Well, we started with China and we went into dividend yields. So I appreciate. Next time we should start with Safari. By the way, ladies, man goes to safaris.
I just came back from Bandhavgarh.
Oh, okay. You obviously did see the big cat.
13 of them.
Wow.
13 cats. Sorry.
I've forgotten the count of tiger actually. Remember that famous ad, only 1919 left. That number's gone high now.
They are totally around 4,000.
Numbers gone high.
And Karnataka has the maximum around 400 in India. So there are enough tigers and there's enough tiger conservation activity happening.
And Bandhavgarh visibility is in any case known to be higher.
Yes.
We'll take notes from you next time.
Thank
Appreciate
you.
your time.
Thank you very much.